China has been hailed for many years as a world power, but could all that be coming to an end? With advancements in technology, economic growth and diplomatic ties that rival the United States, it's clear why anyone would think China is in a pretty comfortable spot to become the next world superpower. However, a deeper look into details reveals a shocking and ominous twist. China could fall short just like Japan did in the 90s. Keep watching as we reveal the secrets behind China's economic boom and an inevitable decline. The details of Japan's economic decline are well documented in history and still fresh in the hearts of many. In the period after World War II, Japan emerged as a poor and occupied country. They had lost, and there was plenty to show for it. But by the early 50s, the country experienced a huge turnaround, an economic miracle. Through significant socio-economic changes and some support from the United States, the country rose quickly to become one of the largest global exporters and boasted the second largest economy in the world, all within a short time. Japan became a major exporter of advanced technology, with many of their goods even surpassing US rivals in durability and performance. Heavy government investments and involvement with Keiretsu meant that Japanese companies could sell goods at a significantly lower price than other markets did. Their economy grew, their currency got stronger, and they were able to strengthen their diplomatic status. They seemed only a few years shy of rising to the top of the global economy before it all suddenly collapsed. The bubble burst in the early 90s, and the cracks beneath the facade began to surface. What happened? Enticed by a promise of continued increase, individuals and corporations kept buying and trading assets aggressively. This led to a rapid increase in the country's price of stocks and real estate as numbers grew to unimaginable amounts in weeks. Land and property values skyrocketed, fueled by speculation rather than intrinsic value. People and businesses were paying outrageous amounts for property and land, often far beyond their fundamental worth, because they were almost certain that prices were going to rise again soon. However, a sudden decline in real estate and stock prices from their previously inflated amounts led to a sharp contraction in household wealth. Consumer spending decreased, and businesses faced serious financial difficulties. The government tried to cushion the sudden change that followed, but it couldn't be helped. Banks that had greatly invested in real estate suffered massive losses. They struggled to recover, let alone support the re-emerging country's economy. The reluctance to let failing companies go out of business resulted in zombie companies. Financially distressed businesses kept afloat with the help of low interest rates and lenient credit policies. These companies, instead of exiting the market, continued to operate inefficiently, hindering overall economic efficiency. If all that wasn't enough, the country was brought to its knees by unforeseen demographic challenges, an aging population and declining birth rates. Older populations typically spend less and save more, weakening consumer demand and causing economic stagnation. The country was plunged deep into economic redundancy, and its people soon found themselves living in a cycle of fear, deflation, and stagnation. Japan's economic troubles caused a problem for around 17 million people, who had a tough time finding work and dealing with economic uncertainty. It's not all doom and gloom, as Japan has slowly but steadily crawled its way out of its previous state of economic stagnation and deflation. Since the economic downturn occurred in Japan, the question that's been on everyone's lips is who's next? China has been following the Asian development model, akin to the growth paths of South Korea and Japan after 1945. This model involves high levels of investment funded by domestic savings, lower household consumption, and robust export growth. While this approach has led to rapid economic growth, it also brings about imbalances over time. Much of the investment may be wasted, and productivity growth can slow down. This pattern led to Japan's economic challenges in 1990 and other Asian countries later on. China's current situation seems vulnerable due to similar factors, indicating potential economic risks. For one, China's birth rate is even lower than what Japan experienced in the past, reaching 0.75% in 2022, and experts believe it may continue to decrease. A declining birth rate poses a challenge because it means there are fewer people for work and consumption. The productive population gets burdened with supporting an increasing elderly population that is less economically active. The property sector in the country is also a concern. Housing prices are currently 20 times the household income in China, compared to 11 times in Japan at the start of the lost decade. Additionally, the residential property vacancy rate in urban China is about 20%, more than double that of Japan in 1990. Japan faced economic challenges and a slow recovery partly due to high institutional rigidity. This was centered around close connections between the ruling Liberal Democratic Party, the state, banks, and keiretsu. Similarly, in China, there's a familiar situation where the Chinese Communist Party, the state-owned financial system, and state-owned enterprises are tightly intertwined, creating conflicts of interest. They function as owners, participants, and regulators, subject to laws but lacking independent scrutiny and adjudication, akin to the situation in Japan. By many indications, China is vulnerable to a real estate bubble burst and declines in asset prices. While this sounds like icing on the cake, here's why we believe things could turn out a little differently from what you expect. Firstly, China's current economic slowdown is mainly due to strict pandemic lockdowns, government crackdowns on technology and education, and tensions with the US. This slowdown also reflects China's shift from traditional growth areas like property and infrastructure to high-end manufacturing and self-reliance in high-tech sectors. In contrast, Japan's lost decades resulted directly from burst bubbles in property and stock markets. These bubbles were fueled by aggressive fiscal and monetary policies after the 1985 Plaza Accord. To curb inflation and asset speculation, the Bank of Japan raised rates until May 1989, cutting them too late in June 1991. Before the burst in Japan, the Nikkei 2025 had a high price/earnings ratio of 60 times, while the current Shanghai Composite Index is around 14 times. Japan's asset bubble burst was worsened by the yen's strong exchange rate against the US dollar, appreciating about 45% from 1985 to 1990. In contrast, China's yuan has depreciated by 4.7% against the dollar in the past 5 years, influenced in part by the stronger dollar, which appreciated by 8.6%. In China, the real estate price correction mainly affected residential property markets in lower-tier cities. Local governments responded with city-specific support measures like reducing down payment requirements, easing first home mortgage criteria, and relaxing home purchase restrictions. China's real estate market has down payment requirements ranging from 60 to 90%, making the sector less leveraged compared to the real estate markets in the United States during the subprime crisis or in Japan in the late 1980s. Importantly, there haven't been major failures among financial institutions. China's banks maintain a low non-performing loan ratio, standing at 1.6% as of June 2023, a significant improvement from 12.4% in March 2005. China's government can still increase the retirement age, and there's potential to shift more workers from rural to urban areas. If the retirement age is raised by 5 years, around 60 to 67 million people, about 7% of the total workforce, could join. Currently, 24% of China's workforce is in agriculture, while it's less than 5% in Japan and the US. China's labor productivity growth is expected to remain high compared to the US or Japan in the 1990s, driven by ongoing improvements in education and training. Last but not least, in China, the government closely monitors the movement of money across borders and has substantial control over both the assets it owns and the debts it owes. The Chinese government maintains strict oversight of the capital accounts and exercises significant control over both assets and liabilities, reducing the likelihood of fire sales and asset bubble bursts. Despite China being a middle-income country, its GDP per capita is still significantly lower than that of the United States and Japan. China has the potential for further economic growth and development in the future. China is in a different development stage compared to Japan when its economic bubble burst. The sleeping dragon has significant potential for catch-up growth, making it easier to develop the economy compared to when it's at the technological forefront. While the similarities are glaring, China can learn from Japan's experiences and take preventative actions. Chinese authorities have thoroughly studied Japan's challenges with changing demographics and the collapse of its asset bubble. The key lesson from Japan is the importance of addressing economic challenges promptly. Japan faced issues due to prolonged misalignment of fiscal and monetary policies and a reluctance to let unproductive firms fail, resulting in the persistence of zombie firms and resource misallocation. In China's case, there are two potential paths. The first involves sustaining economic activity by bailing out banks and real estate companies, alongside allowing real estate prices to rebound, while Beijing has taken steps like cutting mortgage rates. These measures may need to be revised to effectively correct economic imbalances or house pricing. Alternatively, Chinese authorities could directly tackle imbalances and debt. This would require addressing unsustainable debt levels at the local level, especially in local banks. In the medium term, efforts to boost consumption's share of GDP through fiscal support and safety nets for households could be beneficial. In the long term, encouraging the private sector to shift investments from real estate to innovation-intensive sectors would be crucial, possibly through a predictable regulatory regime. However, history suggests caution. China has previously followed a similar playbook in 2015 and 2022, keeping the real estate market active and delaying necessary adjustments. Both times, strong export growth saved the day. But with the global economy slowing and rising geopolitical tensions affecting exports and foreign direct investment, China can no longer rely solely on exports for growth. The question remains whether China will choose to endure short-term pain for long-term economic health. It's uncertain if China's economic fate will mirror Japan's. We believe it depends on how China handles its bursting bubble and demographic changes, and importantly, the government and society's will and ability to act promptly. So what do you think of China's heavy links to Japanification? Inevitable or idle foreshadowing? Let us know in the comments.